Planning for retirement, it can feel like a lot, right? Especially when you throw taxes into the mix. So today, we're going to break down one of the most powerful retirement tools out there, the National Pension System, or NPS. We'll get into exactly how it can help you save on taxes today and set yourself up for the future. Let's jump in. Let's be honest. We all know we should be saving for retirement, but that immediate win of a smaller tax bill, that can be a really powerful nudge. And hey, the government gets this. That's exactly why tools like the NPS are built with some really attractive tax benefits to give us that extra push to build our long-term nest egg. To make this super easy to follow, we're going to look at it like a journey for your money. First, we'll cover all the tax benefits you get when you're actually putting money in. We'll call that the investment phase. And then we'll talk about the rules for when it's time to take the money out, which is the withdrawal phase. Simple as that. Okay, let's dive into phase one. When you're contributing to your NPS account, there are basically three key sections in the tax code that you need to know about. Think of them as three different ways you can lower your taxable income and, shrink that tax bill. First up, we have Section 80CCD1. This is the main one, the one for your own personal contributions to the NPS. Now, the most important thing to remember here is that this is part of the same family as a very popular tax-saving tool called Section 80C, which I bet a lot of you are already using. So this means it's sharing space in that famous 1.5 lakh tax-saving bucket. Imagine you've got this one bucket for all your tax-saving investments, things like life insurance premiums, ELSS funds, PPF. Well, your NPS contribution under this section has to fit inside that same bucket. Now, how much you can put in depends on what you do. If you're a salaried employee, you can claim a deduction for up to 10% of your salary. If you're self-employed, you actually get a bigger limit, up to 20% of your gross income. But, and this is the key part, no matter what that percentage adds up to, the total amount you can claim in this whole ADC bucket is still capped at 1.5 lakh rupees. Oh, and just a heads up, this benefit is only available if you're sticking with the old tax regime. Okay, but here's the really cool part. What if you've already maxed out that 1.5 lakh bucket with other investments? Well, this is where the NPS shows off its superpower. There's a special extra deduction that is only for NPS investors. It's called Section 80CCD1B. This section gives you an additional tax deduction of up to 50,000 rupees. This is totally separate from and on top of that ADC limit. It's exclusively for your NPS contributions. This is a fantastic way to save even more tax. But again, remember, this is a perk of the old tax regime. All right, on to the third way to save. This one applies if you're in a corporate job and your employer also contributes to your NPS account. If you have this, it's a huge perk, and the tax benefit is covered under Section 80CCD-2. So that contribution from your boss isn't counted as part of your taxable salary, up to a certain limit. Under the old tax system, that limit is 10% of your salary. But check this out, under the new tax regime, it's even better. The limit is higher at 14%. And the great news here is that this deduction is available no matter which tax system you choose. Now, there's one last rule here on the employer side to keep on your radar. If your employer is putting money into your NPS, your EPF, and maybe another retirement fund for you, there's a total combined limit of 7.5 lakh rupees per year. If all those contributions together go over that amount, the extra bit gets added to your income and becomes taxable. All right, we've totally nailed how to save tax when the money goes in. So what about the other side of the coin? What happens when you're finally ready to take that money out? Let's get into the tax rules for the withdrawal phase. At retirement, which is usually after you turn 60, the withdrawal rule is actually pretty straightforward. You can pull out up to 60% of your entire nest egg as one big chunk of cash. And as you can see here, the best part is that whole 60% is completely 100% tax-free. That is a huge, huge benefit. Okay, so what about the other 40%? Well, the law says you have to use that chunk to buy something called an annuity. Just think of an annuity as trading a pile of cash for a guaranteed regular paycheck for the rest of your life. Now, buying the annuity itself is tax-free, but the pension income you receive from it, whether it's monthly or yearly, that gets treated as regular income, and you'll pay tax on it based on whatever your tax slab is at that time. Of course, retirement at 60 is the main plan, but you're probably wondering, what about other situations? Life happens, right? What if you need to access some money for an emergency, or if you decide to leave the scheme early? The rules here can be a little different. Well, for some things, the rules are clear. If you need to make a partial withdrawal for a specific reason, like a child's marriage or for higher education, that money is tax exempt. Great.
But when it comes to a full premature exit from the scheme, or for withdrawals from a Tier 2 account, things get a bit murky. The rules just aren't super well defined. It's very likely any gains will be taxed. So for these kinds of specific situations, it is always best to talk to a tax advisor to get the right advice for you.
Phew, okay, that was a lot of information, I know. So let's just take a breath and boil it all down to the key points that you absolutely need to remember.
So here it is, all in one place. On the way in, you've got your main deduction under 80CCD1, which is part of that big 1.5 lakh limit. Then you've got that awesome extra $50,000 with 80CCD1B, and of course the employer's contribution. On the way out, just remember the magic rule. 60% comes to you tax-free, and the pension you get from the other 40% is taxed just like any other income. So the final thought to leave you with is this. Now that you have a handle on the mechanics, how you save tax when you invest, and how the money is treated when you withdraw, it's worth taking a moment to think. How could a tool like the NPS fit into your own long-term financial plan?
Hey, if this breakdown of the NPS tax rules helped clear things up for you, do me a favor and hit that like button. And of course, subscribe to the channel so you don't miss out on more deep dives into topics just like this. Thanks for hanging out with us.